Withholding tax on registered accounts is a bit of a necessary evil and something that the CRA requires if you pull more than the minimum amount. What does that mean? How does it work with integration amongst your other taxes and incomes? Let's break it down in this video. Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Withholding tax is a bit of a complicated scenario for a lot of you. How does it work? Why are they taking more money than I have to pay? Do I get any of it back? And we're talking about withholding tax on registered accounts here in Canada. When you pull money out of a RIF or a LIF, there may be withholding tax on that. The withholding tax has different rates depending on how much you take out. Typically with a RIF, a retirement income fund, let's use that as an example here. With a RIF, anything above the minimum amount for the year that you have to take out will have withholding tax. So let's say that the minimum amount for the year is 3.5% based on your age. So you're early 60s and it's 3.5%. And you have a RIF worth $100,000. You have to take out $3,500 in that year. Now, if you take out more than $3,500, there's going to be withholding tax. And the amount of withholding tax is dependent on how much more you take out above that $3,500. If you take out anywhere from $1 to $5,000 more, you're going to have a 10% withholding tax. From $5,001 to $15,000, you're going to have a 20% withholding tax. And anything above $15,001 and more will have 30% withholding tax. So 15,000 and more, 30%. So that's your highest rate. So let's say you took out $20,000 out of your RIF. Everything above $3,500 is going to have withholding tax. Now, a lot of you try and work around this of taking small amounts and trying to work around the withholding tax. Again, wherever you hold your money will typically look at how you're taking it out. Is it monthly? Is it lump sums? So if you're not sure about how much withholding tax there's going to be, how it works, wherever you're holding your investments, talk to your financial institution to ask them how the withholding tax works. But at the highest level and simplest way to look at it is look at your minimum amount. And again, you can just Google minimum RIF withdrawal based on age. So it's based on your age and then times the amount of your account. So let's say you're 62, it's 3.57%. If you have a $100,000 account, then you have to take out $3,570 to meet that minimum. It's above that threshold where CRA requires the financial institution to withhold tax. Now, what does that mean, withholding tax? Does that mean, if they take 30% and you don't actually owe that much money, are you gonna get it back? So the answer is yes. So think about it like your paycheck right now. Right now, on your every paycheck, there's tax withheld. What your work does, and they're required to, based on the amount that you earn, they have to take off so much tax and remit that to CRA. At the end of the year, you get your T4 slip and it'll say, Joe made X amount and he had so much taken off for tax. Now, hopefully your work took off the right amount of tax so that you don't owe a lot, or maybe the refund's a bit little, but it's pretty close. And that's essentially what CRA is trying to do with withholding taxes around registered accounts. They're trying to say, look, because you're taking out a fair amount of income, we want to make sure that you're not hit with a big tax bill unexpectedly. If you pull a bunch of money from a registered account and the total withholding tax is $5,000 and you do your tax refund at the end of the year and you only owe $3,500 total based on all of your income and they withheld $5,000, you're going to get a $1,500 tax refund. Now, this is where a lot of you are very confused because you think that $5,000 is just a tax. I'm never going to get that back. No, they're just holding on to that. And if you owe less than that amount, they will refund that money. Now, I'm not talking about withholding tax if you're a foreigner, if you're getting Canadian income and you're living abroad. That's a totally different topic, different video, different time, not here today. But if you're in Canada drawing registered income and you have withholding tax, you want to look at how much is being withheld and that will be credited for you at tax time. Now, I want to look at a couple things. I'm going to share my software here in a second in breaking down, like if you're going to do the RSP drawdown, which you should be doing, it's tax efficient for you. It's going to put more money back in your pocket. but that typically means you're taking more than the minimum. So how does this work from tax standpoint? Let's dig into it. So I want to show you this scenario, and this is a, Dave and Ruth YouTube, who we see all the time here, and 62 years old, and Dave's got a nice RSP, 750,000, built it up over time, done very well. And if we just kind of jam it into the system and take the minimum amount, and that's the focus here. The minimum amount for Dave this year is $25,862. Now that's based on his age and the account value at the end of the previous year. Now, if we were to set that up and just take out that minimum amount, there would be by default no withholding tax, meaning he wouldn't pay any tax up front. Now he can request to have some tax withheld, which I would probably recommend for Dave in this scenario because he's not drawing his CPP or OAS. The only income he has is his RIF and some TFSA money, which is not going to be taxable. So he'll have no withholding tax. And if we jump back into here, you'll see Dave's total tax bill for the year is about $1,800, $1,900. If he doesn't have any taxes withheld, he's going to have a bit of a tax bill at tax time, which, of course, I would say, if you have a taxed bill, that means that you've held on to your money longer than CRA has. It's not a bad thing. But I just want to make sure Dave's aware that he's going to have a tax bill. So maybe we say, Dave, let's not withhold any tax. Come tax time, we pull some extra money out to pay for that tax. It all works out the same. It's just the timing of that. You just want to be aware of if you're going to have a tax bill at tax time or not. That's the biggest thing. So again, if we jump back in, $25,862 is that minimum amount. If we don't withhold any tax, he's going to have a bit of a tax bill. Now, I want to look at what happens if we do an RSP meltdown and the difference in how much withholding tax there would be for Dave. So let's assume that Dave plans to draw down $50,000 this year from his RIF. So again, the minimum was let's call it 26,000, just shy of 26,000, and now he's taking 50,000. So he's taking $24,000 more than the minimum, meaning that he's going to have a 30% withholding tax on that additional money. So because of this, if we take 30% of that $24,000, they're going to withhold, CRA is going to withhold $7,200 of taxes. Now, if we look at it, it works out pretty well in this scenario, and it just happened to be. Doesn't typically work out this well, but you can see Dave's tax bill is going to be $7,207. So it's pretty much bang on. So that additional withholding tax pretty much exactly meets his tax liabilities for the year. Thus, there's not really any tax owing or a tax refund. It's a net neutral position. Now let's look at one more year, and this is when Dave's 70 years old. So Dave at 70, the minimum amount is going to be $38,210. Dave is also taking CPP and OAS at that time and is able to income split. So there's a lot more moving parts. If he only took the minimum and he took his CPP and OAS and didn't have any taxes withheld on those, he's going to have to be careful because he still owes about $3,700 of taxes. So again, this is where tax planning and income planning and cash flow planning all have to come together in retirement. So if we go back to the RSP meltdown, again, we've left it at 50,000 just for simple math. So he had to take out 38,000 and he's taking 50. So he's taking $12,000 more than the minimum, meaning that there's going to be a 20% withholding tax. Remember, between 5,000 and 15,000 is 20%. So of that 12,000 additional income that he's taking above the minimum requirement, they're going to hold back $2,400 of taxes. Now, if we look at age 70, he owes about $5,496 of tax. So we've held back $2,400. He still has a $3,000 tax bill based on these numbers. So we either need to take more from the RIF, withhold back a little bit more, or make sure they're taking money off CPP and OAS, or just be prepared to pay a little bit of tax at tax time. So for those of you that are thinking, withholding tax is a scam, that CRA is taking more money than they need to. No. They're just holding on to a bit. Just like when you were working, every paycheck, they took off a little bit of tax. And at the end of the year, that was a credit. And you may have got a bit of a refund, or you owe a bit more. But that's just a tax that CRA is holding on to based on the amount of earnings that you have. So if you have withholding tax, remember, it's not a scam. It's not extra tax you're paying. They're just holding on to it in preparation for your tax bill.